This series is supported by Apollo Global Management, a leading provider of alternative asset management and retirement services solutions. Apollo seeks to provide clients excess return at every point along the risk-reward spectrum and is focused on empowering retirees, building and financing stronger businesses, and driving a more sustainable future. Our next guest is a veteran of the burgeoning private credit industry. She started her career in hedge funds and brought her experiences from multiple financial crises to bear to analyze this fascinating new area and the upside that it provides to investors large and small. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Catherine Beard, who is SVP of Alternatives Consulting at Callan, the investment consultants. She's had a long career in investment consulting and allocation, with a particular focus on private credit, and is based in Chicago. Welcome, Catherine. Thanks for joining me today.
Thanks, Aoife. Happy to be here.
Let's start by talking about your journey into investment. Where did it start, and did it take any surprising turns along the way?
Absolutely. So I grew up in Lexington, Kentucky, the daughter of a Southern banker, generations of Southern bankers, actually. And when I was in college, I worked for my father at the bank. I wasn't necessarily looking to go the finance route, but it seemed like a natural progression. Decided to go out and see the world, had a lot of diverse experiences, but ultimately ended up at business school. It was drawn to finance, no surprise. And right out of business school, had the opportunity to start out at an associate training program at a large bank, Bank of America in this case, in Chicago. And as many may know, these sort of associate training programs are really great training grounds for finance careers. Started out of that training program in sort of Midwest industrial banking. So I would go with the relationship managers to look at auto manufacturers, metal benders, et cetera. And, while I found that interesting because I actually am very comfortable getting out in sort of the real world, I never lived in a bubble. It wasn't the best fit for me. Let's just put it that way. So I looked at the capital markets business at the bank and thought, that's a faster paced, go part of the bank. I'd like to somehow network my way into that, which I did. And a lesson there is early in your career, it's really important to kind of identify where your passion is and then figure out how to get there. And it's easier sometimes to move earlier in your career than later in your career. So I moved over to the leveraged loan trading desk at Bank of America, where myself and three other 20-somethings were managing $1 billion of prop capital, which is just unheard of today. We were really this is sort of mid to late 90s. We were really sort of on the forefront of building out a leveraged loan, syndicated loan trading business. Worked with really smart people, many of whom have gone on to lead teams in that space, and thoroughly enjoyed it. Did a lot of deep credit research, but worked very closely with the traders. After that, this was during a period of significant consolidation in the U.S. banking space, and Bank of America was bought by Nations Bank. We all had to re-interview for our jobs, fun. One day I came in and my boss was gone because they didn't like something about him. And I realized that I didn't want to move to Charlotte, North Carolina, and decided that I needed to make a change. So I started networking within Chicago, which is a big credit-driven region, and had the opportunity to move over to Northern Trust to help build out their high-yield business. And that was a greenfield business, and that seems to be a theme throughout my career. I always sort of have liked to get in on the early stages of building, help being part of a new team, new business. And I was for 7 years at Northern Trust, a fundamental private credit analyst, working with a team, managing, third-party money for high yield. So one thing that I noticed over the years as I was working at Northern Trust is that market technicals started to drive returns a lot more than fundamental analysis. And as a fundamental analyst, that was very frustrating because you could spend days and hours trying to find that best fund that you have a lot of conviction on. You think the business is healthy, moving in the positive direction, but some sort of, in many cases, hedge fund comes and decides to put a short on. So, being constrained in a long only high yield business as an investment person started to feel a little frustrating to me. So I thought, let's see what's out there. And so I decided to target working for a hedge fund where I would invest unconstrained and where I could go long and short. And I thought I was always driven by sort of pattern recognition, creativity throughout my investment career. And I found the hedge fund space to be a lot more creative in sort of how people invest. So I moved over to UBS O'Connor on the credit desk. It was a little bit of a shocker, a little new culture. I was told, there's your Bloomberg and make us money.
And can you just give us a time frame for this? Because clearly there was a moment for hedge funds and there were times when they were exploding, multiplying, their heyday. Can you just paint us a picture of what time this was?
So time frame. So I moved over to UBS O'Connor to the hedge fund about 3 years prior to the GFC. So let's call it 2005, right?
The heyday, still
it really was the heyday. And it was, at the time, pretty exciting. And it really informed the way I look at investing. When people talk about we can't find anyone that's been around through cycles. Well, I was I was on a trading desk actually watching my bonds go down during the global financial crisis, maybe 50 points overnight. So working for a hedge fund, it was a risk, and I'd like to take calculated risk in my career. It was very different than the cozy, very process-oriented, long-only space. And like I said, it was a culture shock because the portfolio manager and lead trader didn't really care about Catherine giving them, a 5-page write-up on this really great idea. They want literally 3 bullet points. Why is this going to make me money? Fantastic experience. Really collaborative culture, which I learned is really a fantastic environment for me to thrive. And during that period, in the run-up of the GFC, we saw more and more really aggressive deals getting done in the high yield space. I was looking at those sort of deals thinking, this is so highly levered. This is a weak business. There's no downside protection here. This market's gone wild, right? And I think looking back pre-GFC, there were a lot of signs going into the GFC that were sort of red flags. So I had my own book when we were moving into 2008 and lived through the crazy of watching my entire portfolio go down 50 points, et cetera. It was a lesson. We were shocked. We'd never seen this before. It was a great time for self-reflection. And I self-reflected that maybe I don't want to do this anymore.
Well, let me just, before we move on to the next phase, because I think there's really two really interesting points. First of all, let's go right back. You mentioned you came from a family of Southern bankers.
Yes.
Coming from a family of bankers, did that affect your approach? Clearly affected your appetite for business. Did you think it affected your attitude to risk and your appetite for risk?
I actually don't. I think what drove my appetite for risk was wanting to get the heck out of Lexington, Kentucky and take some risk to kind of find my place in the world. Wonderful place. I enjoy going back today. But at that point in my career, I'm like, I got to get the heck out of here. I want to take some risk. I want to see the world. I want to take this life as far as I can. So actually not. I think it was more that sort of drive that made me comfortable early on, as early as my late teens and early 20s in taking that calculated risk. And that has definitely been a theme throughout my career.
And then moving to the hedge fund side, clearly a risk there, the feedback, the kind of nature of that role, the nature of the fast feedback, the ability to digest that, did that contribute to you becoming a better investor?
It absolutely did, because there was nowhere to hide, right? Every day you see your marks, right? And if you don't get it right, there's a monetary impact and you could actually lose your job, right? And, I saw that happen to people. And certainly during the GFC, it was very real. And it became very apparent to me that I probably didn't have the energy to rebuild in a hedge fund format post global financial crisis. I'd been on a trading desk for 12 years and really enjoyed the fast pace and all those great things. But I knew that I still love to invest. And I've thought about why that is. And I think it is something that made me a good investor is deep pattern recognition, right? So in the finance world, there are a lot of people like accounting, not for me, definitely not for me, and other sort of very process-oriented finance jobs where linear thinking and being very focused on steps in a process will get you to the end. Whereas in investing, particularly in the hedge fund space, having sort of developed, combined maybe with an innate ability for pattern recognition is really important. It's funny. We used to always joke on the trading desk that we all have ADHD. And truth be told, I think I actually did. Well, I actually know that I have ADHD. So, but I think we were surrounded by people that had the ability to be in a lot of different places at one time, to take a lot of data, see the pattern recognition, and then actually move in it almost. There's a certain controlled impulsivity, if that makes sense, to actually making decisions very quickly. It's not for everybody, right?
And clearly then that pattern recognition can be applied to a trade, but can be applied to a manager and a strategy.
That's
because
right.
You can see what works and what doesn't. So walk us through then your post-GFC movement.
Sure. So I took a break 2008 after GFC. I actually resigned and decided I was going to take a breather. I was up for anything, like maybe I'm never going to go into finance again. Maybe I'll just go start a knitting shop or something. We all go through that phase, or many of us. And it took me about 6 months to start to go crazy. I'm like, I got to get back in. It's a little addictive, but I don't think I want to be on a trading desk anymore. What can I do? So one of my neighbors actually worked at Mercer, the investment consultant, and I'd never even heard of investment consulting, and was talking to her, and she said, I think we're putting together a hedge fund research team in Chicago. Given your experience, you might be a good addition. So I had the opportunity to interview for that position. And I thought, well, this is kind of interesting because I'm actually going to be researching people that do exactly what I used to do. And I think I could have some insight there and make good investment decisions. So I took that role, and indeed, I really enjoyed that role. It was fantastic because my job was to go in and due diligence hedge fund managers and make investment decisions. Who's going to be a winner here? And then that decision would be communicated to Mercer clients, who then would decide whether they were going to invest or not. So a lot of deep due diligence works, and I had sort of a research background, so that made a lot of sense. But what was fantastic was when I went in and spent a lot of time with, very John Paulson or, some of these like iconic hedge fund managers, I was able to talk with them about their book, right? Because, hey, I used to cover Rite Aid, or I used to cover linens and things. Like, I get it. And I was also had a pretty good BS radar, so to speak, when they would bring in analysts to talk about a particular deal, et cetera. Sometimes I'd be like, you know what, really, let's dig in a little bit. And they were always kind of surprised because they were not accustomed to having people that had actually taken real risk asking them questions about their strategy. So I really enjoyed it. I thought, hey, this is really a great role for me. It's research, it's investing, and I come in with, sort of a strong background for really cutting through who the winners and losers are.
And then walk us through. So that's actually very similar to your role at Callan now. I don't know if you want to fill in any more.
Yeah, I do. Yeah. So the story is, how did I end up in private credit, right? And how did I end up in private credit at a time when private credit was really starting to grow? So after my stint on the hedge fund team at Mercer, I had the opportunity to go actually work for a plan out of Ann Arbor, Michigan, the UAW Trust, that had a pool of about $60 billion in capital and was looking to move from a 60-40 model to an endowment model. So they were bringing in a number of people from endowments to kind of build this portfolio. And I was brought in to head private credit. Truth be told, I didn't really understand what private credit was. I'd never been on the private side. I had to learn on the job, essentially, as we all were in a way. Some of us were. And This would have been maybe about 10 years ago. So early adopter of a pretty robust private credit portfolio, like a $3 billion private credit portfolio. So that pivot enabled me to pivot sort of from a declining asset class at the time, right? Sort of the hedge fund space, right? I had focused on credit hedge funds, and a number of the credit hedge fund managers were actually and still continue to enroll, particularly distressed people, more drawdown private credit type strategies. So there were some synergies with what I'd been doing on the hedge fund side. So I had the opportunity to build out a $3 billion private credit portfolio for the UAW Trust. And that was a risk, a calculated risk to take that job, because for 3 years, I was commuting back and forth between Chicago and Ann Arbor. And from a career perspective, I learned so much about being an allocator in that role, worked with such great, smart people, was exposed to a lot, learned private credit. But it did take a toll on my family because I was, going back and forth. So that was a risk and a challenge. And then from that opportunity, I actually moved to doing something entrepreneurial. It got me back in Chicago, helped build a business from scratch that focused on allocating to niche private credit and hedge fund managers for large pensions. I found that I really loved being entrepreneurial. That was really the lesson there. I loved building businesses. I loved being strategic, and I was also investing. And then from that opportunity, I moved over to Callan. I had the opportunity to come over and work with Callan to really beef up and build out their private credit business. I've been there for about 4 years, and it's been, a relatively successful endeavor and extremely fulfilling. And I'm, happy to dig in further on that.
Yeah, it's great. I think it's important also that you point out that one can still be entrepreneurial within a big firm.
Yes.
And you're building a business. And, in a sense, we all need to have our sales hats on. I think everyone should always have a sales hat on at all times. That's my view now. Not naturally a comfortable hat for some people, but ultimately we have to generate business to grow and continue to attract and retain our talents. So I think that growing is key. Clearly, you spotted the private credit opportunity. It hasn't gone away in those 10 years.
We're going to take a short break to hear from the supporter of this series, Apollo Global Management. I sat down with Joe Moran, Managing Director, Institutional RIA Sales at Apollo. I asked Joe what opportunities Apollo was seeing in the private wealth segment.
So Apollo is developing a product suite that solves fundamental retirement and investment needs and is tailored specifically for the individual. Individual investors remain significantly underweight alternatives relative to institutions, and Apollo is committed to being an innovator in the industry, applying the firm's more than 30 years of problem solving for the world's largest institutions to the wealth channel.
And now, back to the show.
Love to talk about what's top of mind now when you think about private credit, in the sense of how is it used in portfolios? I mean, you can talk about maybe the range of ways.
Yes.
Why you think it's attractive. And we don't want to make this too time sensitive, but I would imagine interest rate conditions or not, there's still some resilient characteristics that you think are attractive.
Absolutely. Well, the first thing that I try to explain to clients is that private credit, even though there's a lot of buzz around the asset class right now, it's not a trade, right? We're not trying to pop into the hottest, private credit strategy of the day because, SOFR is at over 5%, et cetera. Golden age of private credit is a phrase used right in the current environment. So we work with anything from large pension clients to RIAs, quite frankly, a really broad segment of clients. And what we are trying to do at Callan is to build diversified, long-term, all-weather portfolios across all asset classes, including private credit. And, some people, when they think about private credit, think about sponsor-backed direct lending. And indeed, that was really kind of the first sub-strategy within private credit that became popular post-GFC as banks kind of stepped away from lending to certain sectors. And I'd say it's about maybe 60+% of the private credit universe. So we view that, sort of that sponsor-backed direct lending space as, a potential core allocation within a broader diversified private credit portfolio. The two drivers of the attractiveness of that particular subsector are, number one, income generation, and number two, capital preservation. And that's really why clients like to put sort of direct lending in their portfolios. That said, as we build out diversified portfolios within private credit, we're not only looking at sponsor-backed direct lending, but maybe opportunistic lending, more lower middle market lending that actually lends to companies that may be privately owned by families, et cetera, sort of non-sponsor-backed companies. So you could build, a diversified direct lending portfolio across multiple subsectors within direct lending itself. And then other areas that we use to diversify that broader private credit portfolio might include things like asset-based lending, specialty finance, which, in some cases are one and the same, a little interchangeable. But instead of being backed by, the cash flows of an underlying corporation, the loans are backed by either contractual cash flows or some sort of hard real assets like real estate, for example. So we think that that's a nice diversification within a broader private credit portfolio. And then we also can think about, some of these multi-strat or opportunistic pools of capital that will rotate across different subsectors in private credit and may actually pop in and out of the liquid markets when there's some sort of dislocation. We think that provides a broader diversification within a private credit portfolio. And many of those strategies have either started or actually acquired teams that are doing some of the nichier uncorrelated strategies like royalties, aviation lending, litigation finance, et cetera. So ultimately, the majority of our clients are looking for the income, looking for diversification, and looking for low losses and capital preservation.
And looking at some kind of evergreen characteristics, I suppose, of this asset class without getting too into today's actual climate, what kind of percentage allocation do you see? Do you see it as been here to stay? It's obviously quite a sister asset class, maybe a private equity. How much do you think will represent portfolios?
Sure. So 4 years ago, many of our clients were moving out of, in a low interest rate environment, we're moving part of their fixed income allocation into private credit. They also, in some cases, were winding down hedge fund allocations and putting that capital in private credit. And today we're actually seeing people move some of their private equity allocations and even their public equity allocations into private credit. We have a number of clients that sort of in the last 5 years dipped their toes into the asset class at say 2 to 3% allocations within their broader portfolio. A number of those clients are now trying to take those allocations up from 2 to 3 to 5, from 5 to 10. We've seen a lot of activity in that respect over the last couple of years.
And if you were to say this sweet spot, do you think it's middle market, large sponsor-backed transactions? How do you think about, I suppose, the cash flow component? Mm-hmm. What I've been surprised at in the RIA world is, I suppose, the income is less important than, say, it is for an underfunded pension plan that is structurally negative in cash flow. And clearly there, that distribution piece is very important. Mm-hmm. How do you see that as evolving?
Sure. Certainly, our large pension clients still do like that cash flow. We do have RIA clients. And yes, they are looking for higher octane type private credit strategies. And those tend to be strategies that are investing in stressed and distressed opportunities, strategies that are deep value, or strategies that provide highly structured solutions to capital needs. Those strategies also, and I'm talking 12 to 15% plus net target returns, those strategies often might have more of an equity upside component on the back end in the form of warrants or some preferred equity or some other equity component. So we have to think a lot about where we draw the line in terms of the credit piece of those return drivers versus the equity piece. But absolutely, there is like a subset of our client base that is looking for more of a total, absolute return type component in their private credit allocation.
And obviously, we're sitting here looking at, quite a crowded even environment for private credit. It seems to have been top of mind. It seems to have never lost its appeal in recent years, even as private equities come under question, venture capitals come into question. Certainly, infrastructure and real estate are a little bit impaired today with some of the concerns. I would say, what keeps you up at night in today's environment?
So a couple of things. There is currently a lot of capital being raised for the upper middle market sponsor-backed direct lending space. There has been a market dislocation in that space recently where traditional sponsor-backed deals that had been done in the high yield market or the syndicated loan market have been gravitating towards private debt solutions. Why is that? It's because the public markets have been volatile, execution has been spotty. And sponsors have learned that private solutions are just easier to execute. My concern about that is that I don't think banks are going to step away from financing sponsor-backed opportunities. And I don't think that this is really a sustainable market share between public and private markets for financing sponsor-backed transactions. I think that there will be a shift back to the banks. And I think that the capital base being raised for that opportunity on the private side may exceed the demand over time. So that's one piece I look at. I've also heard of banks trying to partner with private credit managers to provide a private solution for sponsors. So that's something we're watching. So it's a capital supply demand issue. The other thing that I think is important to watch is many direct lenders are, when they put on their marketing hats, they are showing us that they could, in the current environment, get 10 to 12% net returns for very high quality private debt. But that's in an environment where SOFR went from close to zero to over 5%. So 5% of that incremental return is driven just simply by interest rate movements. So that's a double-edged sword. Certainly you get more return, but also that puts a lot larger interest expense burden on the actual borrower in a macroeconomic environment where you have, inflation, a question about recession. I'm not going to call it one way or the other, but we expect to see cracks in those underlying direct lending portfolios. And we are seeing some cracks today. I think the mad dash to, a large asset man, basically anyone that wants to grow their firm and has some sort of credit capability, all of a sudden wants to be in this business. So this supply demand dynamic could become challenging. And then finally, we are seeing a number of managers in the direct lending space in particular starting to really bring down their fees dramatically, because direct lending is a very highly scalable business. So they need a lot of assets under management to sort of pay for the labor intensity of the business. And so right now we have managers offering, 60 to 80 basis points flat for a direct lending strategy, whereas other managers are still charging more private equity type fees, like 1.25% and 12.5%, or 1 in 10, et cetera. And I worry that there's a quick race to the bottom in terms of fees, but I don't think the cost structures of a lot of these managers are right-sized for the new reality around the economics of the fees. And then one more final is one thing that people don't talk about is many of these private credit portfolios and these direct lenders are very intertwined with certainly sponsor activity. And if you look at these portfolios, there is a huge industry concentration in the favorite PE sectors, which right now happen to be technology, healthcare, and business services. I don't think people are stepping back and understanding that they're really doubling down on these sectors, right? They've got them in their private equity portfolio and they've got them in their private credit portfolio. And private credit is very tied to private equity, and private equity is seeing some struggles around deal flow. There may be a shakeout of the haves and have-nots. The private credit managers are now providing NAV loans, financing private equity sponsors to enable them to keep assets in their portfolios that they can't get realizations on. The two are so intertwined that makes me nervous, and I don't think people are thinking enough about that.
I think we come up with 5 giant areas keeping you up at night. So therefore, it's a surprise any sleep is being had at all. Let's move to some personal reflections now. So we talked about your journey, and obviously any journey that involves hedge funds is going to have ups and downs. It's the nature of the business. Were there any particular setbacks or challenges in that journey that you learned lessons from that have stayed with you that you can share?
Absolutely. One big lesson I learned along the way when I was at Mercer made an acquisition of another smaller niche consultant that had a team that overlapped 100% with our team in Chicago. The two teams were never integrated. We were running parallel. We knew that that was not sustainable, right? But our team out of Chicago was so buried in their day-to-day work that no one thought, I should probably be looking for another job. This does not look like it's going in the right direction. And in fact, that is what happened. Ultimately, the acquired team ended up taking over that business, and our team was kind of summarily marched into a room with HR and told, thank you very much, but you've been made redundant. We saw it coming, right? So lesson learned is always have a plan A, B, and C, and don't ever let the day-to-day tasks cloud your ability to execute around an exit strategy when you see it coming.
Good advice. I suppose tied to that, given you mentioned teams and mentors, have you had one? And not every guest on this podcast has had one, believe it or not. It's actually more have probably not had than have had. But whether it be a career mentor or someone in your field or just someone in your life in general who's had a particular impression on you.
It's always said that finding good mentors early in your career is really important. And interestingly, I did not have, and yet another one, I did not have that person early in my career. I had to scramble and scrimp and scrape and do all those things. I had some really great people that I worked with along the way, and I could, I have a list, but there wasn't someone that was really kind of making sure that I was headed in the right direction. So I had to be scrappy. So that, that was resilient, and those are two good skills. In terms of later in my life, and I've had great bosses and I've had not great bosses, right? But one thing that's been really wonderful is the women in this business have really support each other. And to that point, about 2 years ago, I teamed up with some senior women in private credit, and we have created an organization called Women in Private Credit. And our focus is on creating a strong network for senior women in private credit. As it's a relatively new asset class, a new space, there really wasn't an opportunity for that. So we are putting together mentor programs, next generation programs. I just presented last week a very similar tell us everything about your career and what you've learned type thing with the other two co-founders. So you can seek it out. My current boss is fantastic. I'm always amazed when he's always asking me, Catherine, what do you think? Because I think throughout my career, there weren't as many people that said, so Catherine, what do you think? I really value your opinion. So that's really important.
And how about any words of wisdom or creed or motto that you live by?
Yes. Well, my creed, always be fair and respectful to your people, be collaborative, work with others, be creative. I am not a kind of traditional finance person. I am creative. I am always thinking 2 steps ahead. I tend to be more entrepreneurial, but at the same time, I have to work within the constraints of organizations. So know yourself. Know yourself. I'm constantly trying to know myself better. Ask for feedback. Ask for constructive feedback. Ask not only what's the feedback on the past, but what can I do better? So always be on the journey for self-improvement and self-realization. I think that's important. And then build your people around you that can be supportive, and understand that organizations aren't always going to be your best friends. So you have to learn how to operate within organizations, but understand you also have to really take care of yourself.
And if there was any one piece of advice for your younger self, what would you tell that young girl coming out of Lexington, Kentucky?
Wow, that's tricky, because the other way I live my life is every action I take, I want to do it in a way that I don't have any regrets. And I've been able to live my life from that perspective. So from a personal perspective, commuting away from my family for 3 years, think about where you need to draw the line. The other thing that I would say is it's okay to take a break. I resigned from an organization where I saw a lot of behaviors that did not make me feel comfortable. And that was pretty brave. And I found myself sitting on the beach for about a year before I could kind of get back into the groove, but I never regret that decision. So I would say it worked. Always be respectful of yourself and others, and don't run away from something. Always be running towards something.
Well, I think that's a great place to bring our conversation to a close. I see you as having had a career that is as resilient as the asset class you cover. You have reinvented yourself bravely, as you said, and you've been a great source of wisdom to me and to many others in the community. I think the energy you bring to what you do, But I think what I respect you most for is the BS filter that you referred to earlier in the conversation. I think having someone like you in a leadership position with a BS filter that is as acute and as in tune as it is what ultimately protects your clients and protects the industry from some of the massive amounts of BS that circulate. So thank you so much for coming here and sharing your insights with us.
Thank you, Ethan.
I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors on their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.